Hello students, in our last class we discussed about the insurance, reinsurance and the evolution of insurance law in India. Today let us discuss about the insurance law and regulations existing in our India at present. Object is to discuss the evolution of the insurance law and regulations in India, to enlighten various laws associated with the insurance business, to highlight application of essentials of contract to insurance, to explain various doctrines, principles associated with the insurance contracts and business. Now let us know about evolution of insurance law in India. The concept of insurance is prevailing in India since ancient periods of Manu and Kautilya and Yajnavalkya. In the present scenario, the insurance subject is included in the central list of Indian Constitution. The center has the powers to legislate on the subject of insurance law and enforceable across the country. As such, the insurance law is uniform across all the states, unlike that of US insurance law. The evolution of insurance law can be studied under three different phases, that is pre-nationalized phase, post-nationalized phase and liberalized phase. Phase 1, pre-nationalization period. During the pre-independence period, the British companies established Orient Life Insurance Company 1818 in Calcutta, Bombay Life Assurance Company 1823 in Bombay, and Madras Equitable Life Insurance Society 1829 in Madras, under the respective royal charters to undertake the insurance business in India. The provisions of Indian Company Act 1857 and customs and practices of insurance business provided guidance to form the insurance contract. For the first time in India, on the basis of the English Act of 1909, a new legislation, the Indian Assurance Act 1912, was enacted. It was the first legislation in India to deal and consolidate the entire existing insurance law into one single statute and avoid confusion. In 1928, the Indian Insurance Companies Act was enacted to enable the government to collect statistical information about both life and non-life business transacted in India by Indian and foreign insurers, including provident insurance societies. In 1938, with a view to protect the interests of the policyholders, the earlier legislation was consolidated and amended, and the Insurance Act 1938 was enacted, having comprehensive provisions for the effective control of the insurers. The new Insurance Act 1938 was enacted to direct, advise, caution, prohibit, investigate, search, prosecute, seize, fine, amalgamate, authorize, register and liquidate, if necessary, the insurance companies engaged in the business when they failed in their objectives. The Insurance Act 1938 was amended many a times to consolidate the existing practices of insurance business. In spite of having the regulations, there was a mushrooming of life insurance and general insurance companies. They were fragmented and involving in diversion and mismanagement of insurance funds, dishonoring of claims of the policyholders with one or other reason. There were also allegations of unfair trade practices. Phase 2, post-nationalization phase. A committee was appointed under the chairmanship of S.R. Ranganathan to study the insurance business and law vis-a-vis national economic priorities. On the recommendations of the committee, the Government of India decided to nationalize the insurance business. An ordinance was issued on 19th January 1956, nationalized the life insurance business by establishing the Life Insurance Corporation of India. The LIC absorbed 154 Indian and 16 non-Indian insurers and 75 provident societies and consolidated the life insurance since then. The LIC had established its monopoly till the late 90s, when the insurance sector was reopened to the private sector. In 1972, the General Insurance Business Nationalization Act 1972 was enacted to nationalize the general insurance business with effect from 1st January 1973. About 107 general insurers were merged and formed 4 companies, namely Nation Insurance Company Limited, the New India Assurance Company Limited, the Oriental Insurance Company Limited, and United Insurance Company Limited, as subsidiaries of the General Insurance Corporation of India. After nationalization of the life and general insurance business, the insurance business was under the control of the government. Slowly, monopoly of Life Insurance Corporation grown, leading to bad symptoms in the economy. Many more problems associated with the monopoly and concentration of business in the metros and urban sector, and international economic scenario has prompted the government to liberalize the insurance business for private sector to meet the insurance environment across the globe. The control of the insurance was the competent authority to supervise the operations of the insurance business during the nationalization period. The control of insurance business was initially attached to the Ministry of Commerce of the central government, later transferred to the Ministry of Finance, Government of India. Phase 3, Liberalization period. In 1993, a committee on reforms under the chairmanship of R.N. Malhotra was appointed to review the present insurance system in general and the regulatory system in specific. The committee recommended for a strong autonomous body on the lines of SEBI with sufficient powers of control. An interim insurance regulatory authority was established to undertake the control system on temporary basis till the legislative body is formed. The Parliament had enacted the Insurance Regulatory and Development Authority Act 1999 to regulate the insurance business in India. The IRDA has made many regulations for swift and effective management of insurance business in the country. In December 2000, the subsidiaries of the General Insurance Corporation of India were restructured as independent companies, and at the same time, GIC was converted into a national reinsurer. Parliament passed a bill delinking the 4 subsidiaries from GIC in July 2002. The Insurance Regulatory and Development Authority since 2000 has issued regulations on various subjects of insurance, such as the registration and licensing of insurance companies, licensing of insurance agents, appointment of the corporate agents and brokers, insurance intermediaries, appointment of surveyors and loss assessors, appointment of actuaries, reinsurance in life and general insurance business, obligation of insurers towards the social and rural insurance, solvency margin of insurance companies, preparation of financial statements, guidelines on insurance funds, investments, reporting, microinsurance, and many other topics relevant for smooth function of insurance companies. The important objective of insurance law are to control and regulate the transactions of insurance business, avoid payment of avoidable claims, proper channelization of funds, monitor the whole range activities of insurance industry, promotion and preservance of high standards of professionalism in the conduct of the insurance business, coordination of investments and activities of insurers, provide fair treatment to the policyholders and regulate reinsurance business, create public confidence in the insurance business for long-term stability of the business, protect the insurance business, policyholders and customer, to regulate the channel of funds and investment for national development activities. Insurance and related laws. The insurance business is managed, regulated and controlled by many legislations in India. One of the most important legislation that has the relevance is the Indian Contract Act 1872. The provisions of Indian Contract Act 1872 are applicable to the insurance contracts, more particularly essential elements of contract formation and discharge of the contracts, payment of damages. In addition to the aforesaid legislation, the insurance business has the application of principles of civil law, that is torts, and civil procedure code to handle the civil litigations and settlement of claim disputes. The local mercantile customs and usages also apply to the insurance business wherever the law is silent or ambiguous. The established principles of law such as good faith, fraud, misrepresentation, subrogation, contribution are applicable. In addition to the Insurance Act 1938, the other legislations associated with the insurance business and regulations are Insurance Regulatory and Development Authority Act 1999, Life Insurance Corporation Act 1956, General Insurance Business Nationalization Act 1972, Marine Insurance Act 1963, Consumer Protection Act 1986, Employees State Insurance Act, Motor Vehicles Act 1988, Public Liabilities Act 1991, Indian Contract Act 1872. The insurance and law of contracts. The insurance is a contract between the two parties, the insured and the insurer. Professor Hadley Ivey, in a case Prudential Insurance Company versus Inland Reinsurance Commission 1904 2 KB 658, defines the insurance contract as a contract whereby one person called the insurer undertakes in return for the agreed consideration called the premium to pay another person called the assured a sum of money or its equivalent on the happening of specified event. The general principles of law of contracts are applicable to the contract of insurance subject to local mercantile customs and usages. Section 2H of Indian Contract Act 1872 defines a contract as an agreement enforceable at law. An agreement as every promise and every set of promises forming the consideration for each other. Section 2C. The promise is an accepted proposal, and when one person signifies to another his willingness to do or abstain from doing anything with a view to obtain assent of that other to such act or abstinence, he is said to make a proposal. Accordingly, the essential element of insurance contract are the parties to the insurance contract are the insurer and insured. An insurance contract, the proposal or offer originates from the insured, not from the insurer. The proposal offer has to be made on prescribed form called the proposal form. The party accepting the proposal issues a notice of acceptance with a request to pay the premium. On payment of premium, the acceptance is completed and the contract is formulated. The parties to the insurance contract, the insurer and insurer, should have a capacity to contract and not be disqualified by the law. Consideration in the contract of insurance is the payment or the consent to pay the premium by the proposer and a promise to pay or compensate or indemnify by the insurer in accordance with the terms and the conditions of the incorporated in the policy. A premium is the price for the risk insured. The insurance contract must be in writing and terms of agreement are reduced in a document known as the policy document. Issue of policy document duly signed and stamped is a conclusive proof of completion or formulation of contract. The policy, a document of contract, contains terms and stipulations of the contract regarding the period of the contract and also about the risks and the valuation. The insurance contract can be divided into two classes: life insurance contracts and the general insurance contracts. The life insurance contracts, the event insured is the death or maturity of the policy. The death is certain, but the time of the death is uncertain. On a happening of event of death, it is difficult to ascertain the loss suffered by the insured or compensation payable to the beneficiaries as the sentiments are attached with it. As such, paying the indemnity or compensation to the insured or the beneficiaries of the policies is beyond the scope of insurance policies. In such cases, the amounts are paid as agreed upon in the policies. On term policies, on the date of maturity, the amount due on policy is calculated and paid. In the general insurance contract, the subject matter of the insurance is the asset and its economic value. The claim is paid only when the asset insured is damaged due to happening of an event insured and economic loss is suffered by the insured. The general insurance contracts does not save the asset from damage or stop the happening of the event, but it arranges the payment of compensation as an alternative to the asset damaged. Thus, the general insurance contracts are considered as the contracts of indemnity. The insurance contract may be discharged by the following methods: on expiry of the insurance contract or maturity of the insurance policy, by agreement, by the insolvency of the insurer, on happening of event insured, by operation of law. Foundation of insurance law. The important principles associated with the insurance contracts are utmost good faith, that is abrama fide, insurable interest, law of indemnity, proximity cause. Utmost good faith. The insurance contracts are exceptions to the cardinal principles of the commercial contracts, that is, he who buys should beware. Caveat emptor. The product and subject matter of the insurance is risks. Risks are intangible. The insured, by knowing the quality and quantity of the risks, make a proposal to the insurer through a document known as a proposal form. The insurer, after understanding the material facts and the risks stated in the proposal forms, agrees to indemnify the insured against the risks and facts stated in the proposal. These reasons imposes greater duty on the parties to make a full disclosure of the material facts of the contract. The good faith is a positive duty voluntarily to disclose accurately and fully all facts material to the risks being proposed, whether requested or not. Every circumstantial material which would influence the judgment of a prudent insurer in finalizing the premium and decide whether he will take the risk is called as a material fact. It plays an important role in settling the insurance claims and sources of avoidable litigations. The facts of the contract which are apparent to the eyes of the common man, like the facts of law, facts of common knowledge, facts which control and lessen the risk of contract, facts which could reasonably be discovered, facts which can be revealed during the inquiry or survey, and facts covered by the policy conditions need not be disclosed. But facts which are external and internal affect the risks, facts of history of the products, its advantages or disadvantages, gains or losses, and other facts of subject matter of the contract known to the party should be disclosed. Misrepresentation of the facts or non-disclosure of the facts results in cancellation of an insurance contract. Insurable interest. Insurance contract, being a contract with uncertainty, is often treated as a wagering contract. As such, the insurance contract is not enforceable, but the existence of the insurable interest makes the insurance contract valid. It is a legally recognized interest of the insured on the subject matter of the insurance which is insured. The insurable interest is the legal right arising out of a financial relationship recognized under the law between the insured and the subject matter of the insurance. Presence of the property right, interest, life or potential, liability as a subject matter of the contract and is essential feature of the insurable interest. The insurable interest may be created by the operation of the common law, by contract, or by a statute. Insurable interest and life insurance policies. A person has insurable interest in his own life to an unlimited extent. The law recognizes the existence of insurable interest in the life of one's spouse. This is an exception to the general rule that insurable interest is a pecuniary interest. Law of England and India does not recognize the insurable interest in the policies taken by the parents on the life of their children. But in USA, the courts have recognized the insurable interest if the parents purchase a policy on life of the child. Insurable interest is also recognized in the policies where the creditor has purchased the policy in the name of the debtor and by an employer in the name of an employee to the extent of the partner's share in the business. Principles of indemnity. In general, the contract of insurance is the contract of indemnity in which the insurer promises to indemnify the insured from the loss or damage of the asset. This principle in India is applicable to all the insurance policies other than the life policies because the valuation of life cannot be assessed. All the contracts of general insurance such as fire, burglary, marine are the contracts of indemnity. Marine insurances, fire insurance and property insurance stand in relation to the principle of indemnity. The insurance company indemnifies the insured to the extent of loss suffered by the insured on a happening of the event. Happening of event and suffering of loss are the essential features of the principle of indemnity. It is an established principle of indemnity that the insured shall not receive any pecuniary advantage if the event, although happens and does not result in any loss to the insured. The extent of indemnity coverage is proportional to the injuries or damages caused directly by the happening of event and not the damages linked to the injuries caused remotely. The amount of indemnity is determined by the market value of the property at the time of occurrence of the event, which caused damage to the insured. Proximity of cause. The proximity of cause is the immediate cause that resulted in the loss of the asset insured. It is that cause without which the loss would not have occurred. It is the cause which is most closely and directly connected with the loss, not necessarily in time but in efficiency and effectiveness. When there is a sequence of causes for damage of the asset, the last cause, which is direct and result in the damage of the asset, is considered. If the cause is too remote and has no direct connection in the loss of the asset, it will not have any bearing and the claim may be rejected. An insurer is liable for any loss proximity caused by a peril insured against. Subrogation. Subrogation is a process where one insurance company seeks reimbursement from another company or person for a claim it has already paid. The principle is based on common law principles of natural justice and equity. The subrogation is an extension of the indemnity. The right to file suit for subrogation is an implied condition under the insurance contract. The doctrine of subrogation is to compensate the insurance company for the acts of wrongdoers. The insurance company cannot make profit out of the recovery. Contribution. Contribution signifies payment of money by each of parties interested of their share in any common liability. If a person insures the property with more than one insurer, either for same risk or different risk, and suffers loss and claims this same from the different insurers, and individual insurers are responsible to make good the losses to the extent of the risk insured by them. In simpler words, the claim paid by one single insurer has to be shared by all other co-insurers according to their share in the premium of the risk insured. The doctrine is applicable only when the contract of insurance is valid and a claim has arisen. The subject matter of the insurance contract should be one for all the insurers. The insurance premium paid by the insured is shared by more than one insurer. The objective of the insurance contract should be legal and lawful. Doctrine of reinstatement. The reinstatement is a replacement of asset which is damaged due to happening of event by a similar or identical asset having similar or identical function. The newly replaced asset should have usefulness in place of the asset replaced. The doctrine is an extension of the law of indemnity. It includes the replacement or repair of damaged asset insured. It is applicable based upon the terms of insurance contract included in the policy document. Double insurance. This concept is applicable to all sorts of insurance contracts based upon the principle of indemnity. The cardinal principle of contract of indemnity is to compensate the insured for the losses he suffered, but not to accumulate profit out of the insurance contracts. A person may get his property insured with a number of different insurers, but on happening of event, he will not be permitted to claim the damages from all the insurers and under all the policies he has purchased. He will be permitted to claim the damages either from one insurer or more, but the total insurance claim shall not be more than the loss suffered by him. This principle is applicable to all general insurance contracts, including the marine insurance, motor vehicle insurance, fire insurance contracts. The evolution of the insurance law can be traced to the period of Manu, Kautilya and Yajnavalkya. Indian Companies Act 1857, the Indian Assurance Act 1912 and the Insurance Act 1938 are well-drafted legislations governing the insurance law in India. In the post-nationalization period, the Life Insurance Corporation Act 1956, the General Insurance Business Nationalization Act 1972, the Marine Insurance Act 1963, Motor Vehicles Act 1988, the Public Liability Insurance Act 1991, the Consumer Protection Act 1986 are some of the important acts during the nationalization phase. The Insurance Regulatory and Development Authority Act 1999 and regulations made thereunder are legislations which supported the liberalized phase of insurance evolution. The insurance business based on the insurance contract and all the essential validity contracts such as the offer, acceptance, consideration, capacity of the parties, performance and discharge of the contracts are applicable to the insurance contracts. The doctrines and principles associated with the insurance contract are the indemnity, good faith, proximity cause, insurable interest, subrogation, contribution and reinstatements. Students, now you might have understood the importance of the insurance and the insurance contracts and also various concepts related to the insurance like good faith, insurable interest, double insurance, proximity cause and indemnity. These principles and doctrines play vital role in settlement of the claims. Hope you will understand this and we will discuss another concept in the next lesson. Thank you.